Hello, and thank you for joining. My name is Martin A. Smith. I am the president at Wealthcare Financial Group. Wealthcare is a wealth management, retirement planning, and investment advisory firm. We are located in Peachtree City, Georgia, as well as Washington, D.C. and Maryland. We are a registered investment advisor, and I believe you found this webinar through our advertisement entitled Choose Your Path to Retirement. And again, the nature of this is really to not necessarily tell you what path to take to retirement, because there are many paths. For some, there's an educational route, which is why we're doing these webinars. For others, it may be contacting us, engaging us for a complimentary financial plan. For others, it may be utilizing our online digital investment robo-advice software that we offer. And then for some, it may just be picking up the phone, calling us, and scheduling an appointment. But we want to make certain that we've given you enough choices to make the best decision for you at your pace, at your level of comfort. So this webinar actually, is entitled Estate Planning Basics, an overview of the estate planning process. Now, if you own property, if you own any type of asset, you have an estate. Doesn't mean you're wealthy, doesn't mean you're not, but you have an estate, and that estate may be worth protecting. What I want you to understand in this presentation is the process of estate planning does not have to be very mystical and complicated. We're going to try to demystify estate planning somewhat. No, I'm not an attorney, but we do work with attorneys to assist you with that plan. And also our complimentary financial plan through our online software, it does illustrate your estate plan for you. So if you want to receive a complimentary financial plan and also have a plan for your estate, you can receive that by engaging with us online. So let's start this webinar. I'm going to get my trusty pointer out here, and here we go. So what is an estate plan? An estate plan is really a map, and this map reflects the way you want your personal and financial affairs to be handled in case of incapacity or death. You don't want someone else to dictate what happens to your hard-earned assets. You want to make those decisions on your behalf. Who needs an estate plan? Chances are you do. Not just for the wealthy. I've seen a number of non-wealthy individuals with an estate that had to go through probate or not, but they still need an estate plan. So it's not just for the wealthy. Without an estate plan, you can't control what happens to your property if you die or if you become incapacitated. An estate plan makes your wishes very clear and helps you to avoid family disputes. And as a wealth management advisor, 25 years in this business, I've seen enough family disputes over an estate. Proper estate planning can preserve assets as well as provide for your loved ones. Preserve assets, meaning taxes, and protecting your assets so that perhaps you're not lost in that process. So we're going to go over what proper estate planning looks like. It's especially needed if your spouse isn't comfortable with financial matters, if you have minor children, if your net worth exceeds the federal transfer tax exclusion amount, which is $11,580,000 in 2020, or if less, your estate's exemption amount. And again, if you own property in more than one state, and if financial privacy is a concern, and there are ways to shelter your estate, keep your things private so that people just can't know what you own. And in today's heightened climate of cyber theft and cyber issues, you definitely want some privacy. And also, if you own a business, we own a business. Wealthcare Financial Group is a business. And if you own a business, you want to determine and know how that business is going to be distributed, who's going to run it, manage it, who's going to receive the business as their inheritance and assets. Some basic estate planning concepts. Planning for incapacity. That's one of those difficult situations. If someone becomes, has Alzheimer's or dementia or something, or they cannot perform 2 out of the 6 activities of daily living, like feeding themselves, dressing themselves, toileting, transferring, which is walking, This is where an estate plan especially becomes important. Yes, if there's healthcare concerns, like I just stated, and also with respect to property management, who's going to manage your affairs? Planning for death. What type of burial arrangements do you want? Cremation or traditional burial? Wills and probate. This is very important because in estate plan, the basic process is expressing your desires for who's going to inherit what you've earned and worked for through a will. You're bequeathing it through a will to your intended beneficiaries. A will still has to be probated. Probate court determines the validity and the clarity of your will, and making certain that your wishes are followed properly according to your desires. And probate court is costly. There are ways to avoid that, but you've got to start with a will. And then there's tax basics. There's certain aspects of estate planning that gets pretty involved with taxes. So oftentimes you definitely want to get the true cost basis of various assets, in particular your investment portfolios, stocks, bonds, mutual funds, IRAs, 401ks, taxable, non-taxable accounts. There's tax issues. And there's lifetime gifting. How do you want to gift your assets, if any, to people that, family members or friends? And life insurance also plays an important role in estate planning. You can use life insurance to offset estate tax liability for those who will inherit your estate. And then there's trusts. Trusts are very important. A trust is an entity. We're going to go into what trusts are and how they work later in this presentation. So planning for incapacity. Incapacity can strike anyone at any time. And failing to plan means a court would have to appoint a guardian. Lack of planning increases the burden on your guardian. Your guardian's decisions might not be what you would want. So planning is very important. Healthcare directives. A living will puts your instructions in writing. Okay, a durable power of attorney for healthcare, a healthcare proxy lets you designate an agent on your behalf. So you're going to have someone who's going to work, who you've empowered with power of attorney to designate on your behalf and carry out your wishes with respect to your healthcare needs and directives. And there's also a directive called a do not resuscitate order. It directs that resuscitative measures would be withheld or withdrawn. It's important to state that not all types of healthcare directives are effective in all states, so be sure to execute the ones that will be effective for you. In other words, hire a good and capable estate planning attorney who's able to help you. Now, understand that, when you go to law school, you're going to take basic wills and estates, and you may learn something about trusts. Some attorneys are general practitioners, and they handle a lot of different types of cases. And some attorneys in the estate planning world, if you will, only do estate planning. So determine which type you need, which type you're going to work with. If you just need basic estate planning, I think most attorneys could be of assistance in that regard. But if you need some really heavy lifting, complex expertise, if you will, in estate planning, then you want to find an attorney that only does estate planning work in their firm. Planning for incapacity, again, property management tools. So joint ownership, of course, is having a joint owner has the same access to property as you do. And if you have a brokerage account and it's a joint account, your spouse, you can transfer those funds out into a single name account if they're a joint on the account. So determine how you want property to be owned in your estate. Durable power of attorney lets you designate an agent to make decisions on your behalf. And a living trust lets a successor trustee take over the management of trust property. A trust is an entity. It has its own tax ID number. Your assets goes inside the trust. The will directs who receives your assets. And you are the trustor. The trustee takes over the management of the trust property, the assets in the trust, and then you have the beneficiaries of the trust who are going to receive those assets. Usually a living trust will bypass the court probate process in some instances. In some cases it might not if it's contested or not, but it typically, I think in most cases will. And I highly recommend you sit down with a financial advisor and an attorney to discuss whether or not a trust is right for you. What happens if you die without an estate plan, also known as dying intestate? Some property passes automatically to a joint owner or to a designated beneficiary, IRAs, retirement plans, life insurance, and trusts. All of the property must be passed according to state intestacy laws, which means going to court. Intestacy laws, they vary from state to state. Typical patterns of distribution will divide property between surviving spouse and children. Your active wishes becomes irrelevant, and many potential problems could result. One such problem I've heard of is, for example, unfortunately, divorce is rampant in our country. And so a person who has, let's take a husband, a man who's married to a woman, he has his wife, and they get divorced. He did his estate planning with wife number one, and he has wife number two. Okay, and then they get divorced some years later, and he has wife number three. So unfortunately, 2 divorces and third wife. But for whatever reason, he didn't go back and change his estate planning, his estate plans. Depending on what state he's in, if he passes away, who's going to receive the assets? Who deserves the assets? Wife number 3 may think so, but guess what? In some cases, wife number 1 is going to receive those assets. So it's very important to understand that your wishes become irrelevant if you die without an estate plan. Here's an example, a typical intestate distribution pattern: husband, father, wife receives 1/2, child 1/4, the next child 1/4. Sometimes children stop talking to parents, and there's unfortunately strife in parent-child relationships. And, I've had one client years ago where, one child was sort of disowned by the family, and they had to change all the estate plans to make sure that they disinherited that one child for whatever reason. But these things occur, and without an estate plan and without reviewing your estate plan at least every 3 to 5 years, which you should do, your wishes become irrelevant. So you've got to stay on top of that. Now, a will and probate. A will is the cornerstone of an estate plan. A will is where you express what your wishes are, and it directs how your property will be distributed. It names the executor and guardian for your minor children. If you have young children, then you're going to have to name not only an executor for your will, but who's going to be the guardian for your children. That's important, because what if you have a $3 million estate, your kids are 5 and 7, and you've got a guardian, maybe it's your brother, your sister, or a friend. Are you just going to leave $3 million in the hands of that individual and trust that they're going to do what's right for your children? You can become very specific on the management and distribution and disposition of those assets for the benefit of the child in your will. But it's really important. It's very important to make certain that you've thought through that carefully with an attorney. It is sometimes stressful, but it is well worth it. And wills and probates can accomplish other estate planning goals like minimizing taxes. And then, of course, your will has to be written, signed by you, and witnessed. Now, the probate process. Most wills must be probated, and will is filed with the probate court. Usually when an estate goes in probate, the estate is frozen. The assets are frozen, except to pay court costs and attorney's fees. So other expenses can sometimes kind of fall by the wayside. And depending on if it's contested or not, or how long the probate process is, your dependents, your children, or whoever's in control of your estate are going to need access to assets to cover other expenses. An executor collects assets and pays debts, files tax returns, and distributes property to the heirs. Typically, the process lasts several months to a year. Now, I've had clients who had estate plan probate issues that goes on for 2 and 3 years. In the worst case, the longest scenarios, but typically several months to a year, depending on the complexity of the estate and if it's contested or not. Some pros and cons of wills are as follows. Pros are the time and costs are typically modest, and they're court supervised, and there's protection against creditors. But the cons are it could sometimes be time consuming for complex estates, and title transfers can be delayed. There are fees, there are ancillary probate issues, and it becomes a matter of public record. So everyone now has access to knowing that your estate is in probate. And that really gives creditors, some legitimate and unfortunately some who may not be legitimate, they come knocking asking for money. So this process can be a little tedious. Can you avoid probate? Yes. An estate can be designated to control which assets pass through probate and or to avoid probate. But that requires some special things you've got to do thinking ahead. For example, owning property jointly with rights of survivorship. That's the key. Joint owner with rights of survivorship. That means you survive one another for that joint property, and it won't go through probate. Complete beneficiary designation forms for property such as IRAs, retirement plans, and life insurance. If you complete the beneficiary designation forms, then yes, we know who the beneficiary is. Otherwise, that has to be determined through the probate process. Or you could use a trust, which I highly recommend. Use a trust to be more specific. And then you can make lifetime gifts, which we will cover later in this presentation. Some tax basics to be concerned with and understand there are transfer taxes, and they include federal gift tax, and it's imposed on transfers you make during your life. Federal estate tax is imposed on transfers made upon your death. And then there's federal generation skipping transfer tax, GST, and that's imposed on transfers made to individuals who are more than one generation below you, such as grandchildren, both during your lifetime and upon your death. And there are some tax benefits for making those tax transfers while you're alive. Transfer taxes imposed on a state level tend to affect smaller estates. So taking a closer look at this process, tax basics under the federal gift tax, a lifetime transfer, you're the donor, and the donee, the person receiving the gift tax may apply. However, while gift tax applies to transfers made during your life, certain gifts are excluded. For example, $15,000 annual gift tax. And then there's an $11,580,000 exclusion from all transfers, gifts, and estates combined in the year 2020. So the $11,580,000 exclusion is the largest in the history of the federal gift and estate tax. Kind of understand why Trump's tax plan is very, very popular among the wealthy, because imagine you got a $100 million net worth or a $50 million net worth, and you want to transfer a sizable amount of your estate through gifts and so forth. Well, the old tax plan didn't allow such a large amount of assets to be transferred and be excluded from transfer taxes. So these new tax plans by the president, it helps the wealthy. Doesn't do much in this regard for those who are not wealthy, but they tend to favor the wealthy because wealthy have big estate issues usually. So some basics in federal estate tax is, and let's just get this on the screen here. Your estate transfers at death, there's a beneficiary, estate taxes may apply. So estate tax applies to transfers made at death, generally does not apply to transfers made to spouse or charities, and the $11,580,000 excluded from all transfers is still there combined in 2020. Any portion of exclusion used for gifts will be unavailable to the state. Think about it from this perspective with respect to taxes. Now, you work all your life, you pay taxes. And then when you're retired, now at age 72, you've got to take your required mandatory distributions out of your 401k or IRA through the remainder of your life. Let's say 25 years, you're paying taxes every year. And then when you pass away, there's more taxes. So the IRS government just taxes you through the entirety of your life. No wonder people want to find a way to avoid taxes. And not only does a tax cut help, but estate planning is one of the best ways to reduce estate tax liability and taxes overall. So federal estate tax, let's take a look here. Oops, let's go back. I went too far. All right. New feature important for married couples. Okay, if you're married, listen up. And the exclusion is portable. The unused portion left by deceased spouse can be transferred to surviving spouse. $23,160,000 can be left to beneficiaries tax-free in 2020. Do you have $23,160,000 to leave to your beneficiaries in 2020? If you do, please call us. Again, we understand why the Trump tax plan is so popular, because this does a lot for the wealthy. All right, federal generation skipping transfer tax. Transfers during life or death, your estate, use my pointer more. Here's the donee, the beneficiary. But listen, you see how the line here, look at this, the line skips the child and goes to the grandchild. So you can skip a generation. Grandchild skip, donee, the beneficiary. Generation skipping transfer tax may apply. And the generation skipping transfer tax may apply to some gifts made, to transfers made to someone more than one generation below you. But this is one way estates are transferred by the wealthy. $11,580,000 GST tax exemption is there. It says that it may apply, but there's an exemption there in 2020. So you can transfer $11.5 million tax exemption in 2020. Unlike the gift and estate tax exclusion, the GST tax exemption is not portable. All right, so it's not portable to spouses in that regard. Some transfer tax basics. The top tax rate in 2018 was 40%, same in 19 and 20. The gift and estate tax exclusion amount grew from 11.1 million to 11.4 million to 11.5 million, $11,580,000 over the last 3 years. And the GST tax exemption, the same, 11.1 to 11.5 million dollars. So lifetime gifting, it allows you to see the recipient enjoying your gift. That's a beautiful thing. When you have children and you want to, I've got 7 children, my wife and I, through our marriage, been married 25 and a half years. She gave birth to all 7 of our children, 6 beautiful daughters and a son, 2 out of college, 2 in college, 3 homeschool. I want to be able to gift to our children and to their grandchildren while they are alive. I want to see them receive the gift that I give them so that they can understand the legacy that is being passed down to them. That's important. You don't want to just have kids inherit money and have no connection to not only where it came from, but why they're receiving it. Just kind of grow up thinking that's how the world is. I'm born into money. Well, some people may be, but you still want to be able to give them some instruction and give them some and exhort them in the right way and help them understand the importance of the gift they're receiving as a steward. Okay, you want to pass down I call it the fiduciary responsibility of stewardship to your children and your grandchildren. One of the biggest benefits of lifetime gifting, in my opinion. Lifetime gifting, it lets you minimize transfer taxes by taking advantage of the $15,000 annual gift tax exclusion and other tax deductions. And it removes the future appreciation of property from your taxable estate. So the property still appreciates, but it appreciates for the benefit of your children and grandchildren, Therefore, your taxable estate and that liability for that taxable estate has been reduced. And there's no step up in basis. Your basis in the property carries over instead. Some of the benefits. Now, transfers excluded from gift tax. You can give $15,000 to as many individuals as you want through the federal gift tax. $30,000 if you and your spouse make the gift together. So now my kids, I can imagine what they're going to say if they're watching this seminar. They're going to have their hands out. Where's my $15,000? Or where's my $30,000 times 7 children? Oh my goodness. If you're contributing to a Section 529 plan, you can give $75,000 or $150,000 with a spouse, gift tax free. No gift tax on amounts paid directly to a school for an individual's tuition. That's important. And finally, no gift tax on amounts paid directly to a medical care provider for an individual's medical care. That's a good use of the new tax code. So let's talk about trusts now. Trusts, there's various types of trusts, okay? And they really differ depending on ultimately the complexity and the size of one's estate and family and business or businesses. So trusts are versatile estate planning tools. They can protect against incapacity, avoid probate court, as well as minimize taxes. It allows also for the professional management of assets. So if you want to work with a investment advisor such as myself, Wealthcare Financial Group Incorporated, one of our advisors, whether in Maryland, Bethesda, Frederick, DC, Georgia, soon to be Kentucky and Louisiana, you're able to do that with and through your trust. We can manage trust assets in our firm. It provides safeguards for minors, children, elderly parents, and other beneficiaries. And finally, it can protect assets from future creditors as well as give you control over the property. The trust can have control over the property. So what is a trust? A trust is a legal entity that holds property. Simple as that. Parties to a trust are the grantor, which is yourself, the trustee, who you select, the beneficiary. There are living trusts and there are testamentary trusts. There are revocable trusts and irrevocable trusts. A living trust, also sometimes referred to as an inter vivos trust, is created by the grantor during his or her lifetime. A testamentary trust is a trust created by the grantor's will. In a testamentary trust, property must pass into the trust by way of the will and must go through the probate court process. So in this diagram, we can see the grantor, the trust agreement, trust property, trustee who manages trust property according to trust agreement, and the beautiful beneficiaries who have a right to trust property under terms of trust agreement. Life insurance. Now, life insurance does a lot more than just provide a death benefit to cover, replace someone's expenses and income and to pay expenses. Yes, it does that, but life insurance is also a very important estate planning tool when used correctly. It can provide an instant estate. One of the things that we recommend for some of our clients who receive required mandatory distributions from their IRA or 401k, but may not need those funds because they have enough money already, but they still have to take the RMDs on an annual basis, is I say, okay, look, if you don't need the money, but you're getting taxed on those funds, take those funds rather than put it in a savings account or a brokerage account, which is going to either generate some interest and then later generate taxes or have appreciation, realized gains, and more taxes. Take those funds and fund an index universal life insurance policy. Why? Because the cash value in that policy is invested in an index, a stock market like index, and it grows tax deferred. You can borrow the money or withdraw it, same difference, borrow the money tax free. And those funds are protected against loss from a negative performance in the index. And by the way, you still are adding to the value of your estate. So let's say, for example, you had to take 5% of $1 million, so $50,000 for your RMDs, and you don't need $50,000 because you have money elsewhere. Well, now Uncle Sam says, take it out because we want to tax you one more time every single year. So you can take that $50,000 and you can, after the taxes, maybe you've got, I don't know, $36,000 left. 36 grand, put that into an index universal life insurance policy. Let the cash value compound tax deferred. Choose the most aggressive index option. Why? You have nothing to lose because there's no, you're protected from loss on the downside. If the index is negative, you get the base yield of the policy, the base interest rate, which is like 2% usually. If the index is negative, you get the base interest of the policy. If it's negative, so there's no loss. If it's positive, you get the positive, you get the upside. So you get all the upside and no downside. So just go ahead and put the cash there. And by the way, how much of an additional estate can you create with, in this example, $36,000 added and to your to use to purchase a life insurance policy? Maybe that $36,000 can buy an extra $400,000 or $700,000 of death benefit that is paid tax-free to your beneficiaries. So there are some things you could do. Now, of course, you've got to go through some health underwriting and so forth, but there are some ways to, I think, take control of the situation, especially with respect to RMDs. Life insurance, it provides an instant estate like I just described. It can provide needed estate liquidity, which I mentioned, and life insurance proceeds are included in your estate for federal estate tax purposes unless your estate plan addresses the issue. Key issue is ownership of the policy. That's the issue. Who owns the policy? How do you do that? So let's talk about ownership in this regard. You can have a life insurance, irrevocable life insurance trust, ILIT, okay, during your life. Irrevocable life insurance trust. You're the insured. Here's your irrevocable trust. Here's the insurance company. They provide the policy to you. You, the insured, create an irrevocable trust and name a trustee and beneficiaries. The trustee purchases life insurance policy on your life, and the policy is owned by the trust. You make regular cash gifts to the trust. The beneficiaries technically can withdraw cash gifts during limited window of time. The trustee uses cash gifts to pay the premiums. Now, at death, insurance company, irrevocable trust, beneficiaries. The ILIT, Irrevocable Life Insurance Trust, receives proceeds of life insurance policy. The proceeds are not subject to estate tax. The proceeds are distributed according to the terms of the trust. The beneficiary receives full proceeds free from estate tax. How wonderful is that? So in this regard, you have implemented a plan for incapacity, health, and property. You have to ask yourself, do you have a valid will? If you do, when was the last time it was reviewed or updated? Has things changed materially, financially in your overall estate that warrants your will to be reviewed and updated? Well, it should definitely be reviewed, but it's questionable if it should be updated or not. Are transfer taxes a planning concern for you? And does your overall estate plan reflect your current wishes and circumstances? By the way, if you're going to retire to a different state, just know that those state laws are different from where you currently live, and that's one good reason to update your estate plans. So that's basically estate planning basics. I told you it was basic. Our next webinar, we're going to go into more advanced estate planning. So if you want to go with us in this more advanced discussion about estate planning, then I highly recommend you watch the next webinar, Advanced Estate Planning. Thank you so much. I represent Wealthcare Financial Group. My name is Martin A. Smith, And please contact us to schedule an appointment or ask a question. Here's my phone number, email, and address. We're very grateful that you decided to join us. And